EPK Capital presents Deep Dive on Linde PLC. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your AI host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about Linde PLC. Linde PLC is a global multinational chemical company and the world's largest industrial gas supplier by both market share and revenue. The company's story began in 1879 in Wiesbaden, Germany, when German scientist and engineer Carl von Linde founded Linde AG to capitalize on his pioneering refrigeration patents. Over a century later, a pivotal event reshaped the industrial gas landscape. The American company, Praxair, which was founded in 1907 by Carl von Linde himself, was a part of the Union Carbide Corporation for many years before it was spun off as Union Carbide Industrial Gases in 1992 and then renamed Praxair. In 2018, these two entities, Linde AG and Praxair Inc., merged in a landmark transaction to form the powerhouse now known as Linde PLC. The merger was an all-share merger of equals valued at $75 billion, creating the undisputed leader in the industrial gases sector. The combined company is headquartered in Woking, United Kingdom, and is registered in Ireland. Leadership and business structure. Linde is led by a team of experienced executives with deep roots in the industrial gas industry. The current chief executive officer is Sanjeev Lamba, who was appointed to the role in March 2022 and also joined the company's board of directors. Lamba's tenure with the company dates back to 1989 when he started in a finance role with BOC India, a Linde predecessor. Before becoming CEO, he served as Chief Operating Officer and Executive Vice President, showcasing a long and methodical succession plan from within the organization. The company's operations are divided into two primary business areas: gases and engineering. The gases segment focuses on the manufacturing and distribution of a wide array of gases, including atmospheric gases like oxygen, nitrogen, and argon, as well as process gases such as hydrogen, carbon dioxide, and helium. These products serve a diverse range of end markets, including healthcare, manufacturing, electronics, and food and beverages. The engineering division designs and constructs large-scale industrial plants for the production of these gases, including hydrogen and carbon capture facilities. This is a critical business area that supports the long-term, high-margin on-site contracts that form a key part of the company's business model. A thorough analysis of Linde's financial and operational profile requires a full understanding of the 2018 merger. The data clearly shows a massive transformation in the company's scale immediately after this event. For example, revenue jumped from $11.36 billion in 2017 to $28.23 billion in 2019, while net income surged to $229 billion from $125 billion in 2017. This demonstrates that the company's current financial strength and market position are a direct result of this strategic consolidation. Therefore, a look at Linde's financials over the last decade is not a single linear story, but rather a tale of two distinct eras: the pre-merger era of Linde AG and the post-merger era of Linde PLC. Decoding the numbers: a 10-year financial journey, revenue and profit growth. Examining Linde's financial performance over the past decade reveals a clear narrative of aggressive growth and enhanced profitability following its transformative merger. Before the 2018 merger, the combined entity's revenues were steadily growing, reaching $11.36 billion in 2017.9. However, the formation of Linde PLC in late 2018 caused a profound shift, with annual revenue leaping to $28.23 billion in 2019 and climbing to $33.01 billion in 2024. The trajectory has been consistently upward since the merger, with the exception of a slight decline in 2023, yet the company continues to demonstrate robust top-line performance. This growth in revenue has been accompanied by a consistent increase in net income, which serves as a testament to the company's operational discipline. Net income has risen from $2.5 billion in 2020 to $6.57 billion in 2024, representing a substantial climb. This steady and predictable profit growth is a hallmark of a mature, well-managed company operating in an oligopolistic market. Key financial metrics. To further understand the company's financial health, it is essential to look beyond top-line figures and analyze its profitability and debt management. Profitability. Margins. Net profit margin. The net profit margin, which shows how much profit a company makes for every dollar of sales, has shown a significant upward trend. Linde's net margin has increased from a low of 8.09% in 2020 to over 20% in the second quarter of 2025. This indicates that the company has become more efficient at converting revenue into profit. Operating margin. The operating margin, which measures a company's profit after paying for variable costs of production, has been consistently impressive. At around 27.37%, it is well above its 5-year average and the broader market average, suggesting that Linde possesses strong pricing power and benefits from significant economies of scale derived from its industry leadership. Debt and financial health. Linde's debt levels have increased, with long-term debt rising from approximately $12 billion in 2022 to $16.1 billion in 2024. The company's total debt is approximately $25.9 billion, giving it a debt-to-equity ratio of 64.8%. While this may appear high at first glance, a more detailed look at the company's cash flow and earnings provides a more complete picture. The company's interest coverage ratio is an exceptionally high 64.6x, meaning it can easily meet its interest payment obligations from its earnings. Furthermore, Linde has generated strong operating cash flow of $2.2 billion in the second quarter of 2025, which comfortably supports its operational needs and investments. This analysis shows that the rising debt is likely a consequence of the company's strategic capital deployment, such as investments in new hydrogen plants, rather than a sign of financial weakness. The value investor's perspective. A Benjamin Graham valuation. The revised Graham formula. Benjamin Graham, the father of value investing, devised a simplified formula to help lay investors estimate the intrinsic value of a growth stock. The core principle of Graham's philosophy is to find stocks trading at a price significantly below their intrinsic value. While Graham himself cautioned that his formula is not an exact science, it provides a valuable framework for a value-oriented perspective. The revised Graham formula, which accounts for prevailing interest rates, is V YEPS SX, ER 8.5 plus 2G, X 4.4. Here's a breakdown of the variables in simple terms. V, the intrinsic value of the stock. EPS, the company's earnings per share for the last 12 months. 8.5, a base PE ratio for a company with zero growth. G, the expected annual EPS growth rate over the next 7 to 10 years. 4.4, the historical average yield of high-quality corporate bonds in 1962. Y, the current yield of high-quality corporate bonds, applying the formula to Linde. To apply this formula to Linde, the following data points are necessary. Earnings per share, EPS. The latest available trailing 12-month EPS for Linde is $14.16. Expected growth rate, G. Analyst consensus forecasts project Linde's annual EPS growth to be around 9.3% to 10.7%. A conservative growth rate of 10% can be used for the calculation. Current ALA corporate bond yield, Y. Recent data from a credible source places the Moody's seasoned ALA corporate bond yield at 5.13% in September 2025, while another source provides a value of 4.553%. Using a blended average of 4.83% provides a balanced and conservative figure. The resulting intrinsic value of approximately $367.55 is significantly lower than Linde's current share price of $482.04. This calculation suggests that, according to the principles of Benjamin Graham, the stock is currently overvalued. This divergence between the formula's output and the market price is not an outright condemnation of the company. Instead, it highlights a fundamental difference in valuation philosophies. The Graham formula does not account for qualitative factors that the market appears to be valuing, such as Linde's dominant market position, its strong pricing power, and its aggressive investments in emerging long-term growth areas like the hydrogen economy and semiconductor manufacturing. Therefore, while a pure value investor might view the stock as too expensive, a growth or quality-focused investor may consider the premium to be justified by the company's superior business model and long-term prospects. The tug-of-war, bull versus bear case. Bull case, reasons for optimism. The case for optimism surrounding Linde is robust, built on a foundation of market leadership, a resilient business model, and strategic future-facing investments. Unrivaled market dominance. As the world's largest industrial gas supplier, Linde holds a commanding position in a highly concentrated market, with an estimated 33% global market share. This oligopolistic structure provides a powerful competitive advantage and pricing power that smaller competitors simply cannot match. Durable moat. The company's business model is characterized by long-term, on-site contracts with major industrial customers, which provide a stable and predictable revenue stream. This structural advantage reduces business risk and insulates the company from short-term economic fluctuations. Future-proof. Growth catalysts. Linde is at the forefront of major secular trends. The company's project backlog has nearly doubled in 4 years to $7.1 billion, with a significant portion of this growth tied to clean hydrogen and semiconductor manufacturing. These investments demonstrate a clear strategy to capitalize on the energy transition and the booming electronics industry, providing a runway for future revenue and earnings growth. Operational excellence. Management has demonstrated a consistent ability to exceed analyst expectations, a clear sign of operational efficiency and cost discipline. This performance has translated into industry-leading margins and a high return on capital employed, further reinforcing the bull case. Bear case. Reasons for pessimism. While the bull case is strong, there are legitimate reasons for a pessimistic view, primarily revolving around the stock's valuation and exposure to market cycles. High valuation. The most prominent bearish argument is the stock's rich valuation. Linde's PE ratio is currently trading at a premium compared to its historical average and the broader market. This high valuation leaves little room for error. Any significant business misstep or a broad market downturn could lead to a sharp price correction. Cyclicality. Despite its defensive nature, Linde's revenue is still tied to industrial production. A severe global recession could reduce demand for industrial gases in key sectors like metals and energy, impacting revenue and profits. Regional headwinds. The company has faced specific challenges in certain regions. For example, a drop in sales was reported in the Asia-Pacific region, coupled with flat pricing. The company has also experienced a decline in U.S. home healthcare revenues due to weakness in the sector. These issues highlight vulnerabilities in key geographic and business segments. Beyond the financials, important checks, controversies, and legal issues. Linde has not been immune to legal and regulatory scrutiny, which is a common risk for a company of its size and scope. One significant legal issue is the ongoing dispute with Russian-Alliance LLC, RCA. This dispute arose from the termination of an engineering, procurement, and construction (EPC) contract for a project in Russia following the country's invasion of Ukraine and the imposition of international sanctions. The conflict has resulted in a complex web of legal battles across multiple jurisdictions, including Russia, Kazakhstan, the Netherlands, and the UK, demonstrating the geopolitical and legal complexities that a large multinational corporation must navigate. In addition, the company has faced environmental violations and fines in the past, such as a 2019 lawsuit over waterway pollution in Los Angeles and various fines for violations of pipeline safety and air quality standards. While these events are serious, the fines are relatively minor compared to the company's overall revenue and market capitalization and are not recent, suggesting they are a part of the operational risk of a large industrial business rather than an indication of a systemic problem. Global market position and competition. Linde's position as the world's largest industrial gas supplier is a core part of its investment case. The company operates in a highly concentrated market alongside a few other major players, primarily air liquide and air products and chemicals. While air products and chemicals may be considered a better dividend stock due to its higher yield and a much longer history of dividend increases, Linde consistently outperforms its competitor on key profitability metrics. Linde's net margin of 20.20% and return on equity of 19.09% are both higher than air products and chemicals' respective figures of 12.86% and 15.11%. This suggests that Linde's sheer scale and operational discipline give it a powerful advantage over its peers. Conclusion. Linde plc presents a compelling and complex profile. It is the undisputed market leader in a vital, oligopolistic industry with a business model built on stable, long-term contracts. The company has a clear track record of operational excellence, consistently expanding its profitability and generating strong cash flow. Its strategic investments in future-facing technologies like hydrogen and semiconductors provide a credible pathway for continued growth. However, this quality and stability do not come cheap. The stock trades at a significant premium to its historical averages and appears overvalued by traditional metrics like the Benjamin Graham formula. The fundamental question for any potential investor is whether the company's unmatched quality, market dominance, and future growth potential justify its high price. It is crucial for any individual to conduct their own thorough research and consider their own investment goals and risk tolerance. All financial decisions should be made with a full understanding of the potential risks and rewards. Disclaimer: this report is for informational and educational purposes only and should not be construed as financial advice. The analysis presented here is based on publicly available data and may not be exhaustive or predictive. All investments carry risk, and past performance is not indicative of future results. Please consult with a qualified financial professional before making any investment decisions. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next.